we're talking hundreds and hundreds, if not millions of dollars in difference for most physicians, just by that almost 0.5% performance differential. Good afternoon, James, AFib here. Okay, topic of today's quick presentation is how to optimize the investments within your 403b or 401k, your clinic, at your hospital, or if you own your practice. Of course, the key here is getting this right really does have a meaningful impact on how that account performs over time. All right, so there's kind of two sections here. We're going to hit on the actual 403b, 401k investments and how that looks over time. And then the second part of this, we're going to zoom out to kind of the investment philosophy that's supporting these results. Okay, so on your screen here, right, we got two lines, a blue line and an orange line. And if given the option to pick between what performance a physician might want in their 403b or 401k, almost everyone is going to pick that blue line, right? Why? Because starting with $100,000 back in 2017 here, and we look at how that money grew up until end of business last month, relative to the orange line, obviously the blue line did better. Okay, so that's easy. Everyone gets that. What is the orange line? The orange line represents a target date fund, okay? And most times when physicians come to us, this is the type of investment that they have in their retirement account. Or they have some spattering of options within their, they have a kind of a breakdown of different investment options within their 401k or 403b. That also happens too. I'll tell you why we didn't use that in this case. We're just going with the target date option. But the target date side of things is very simple, right? A target date fund, this is going to say something like 2040, 2030, 2060, 2055 in your investment lineup. What that is referring to is a fund that will automatically over time become more conservative as one approaches their retirement, right? In this case, like 2045, 2050, the date is, or that year is telling you at what point the fund kind of is targeting for a retirement. Yep. So what I did is I pulled up Voya and Vanguard, their target date retirement funds, right? So Voya here, they have a whole mess of funds, right? But it's the same for everybody. The percentage of equity in that target date fund automatically decreases, right? In this case, when you're about 20 years out from retirement, over time, until you hit retirement, to where it reduces its stock down or equity down to 35%, and the bond side is 65%, right? Same thing in Vanguard, right? This is just giving you totals 100%, right? And it's just looking at the breakdown of U.S. stocks, international, and bonds based on these different colors. But the same rule applies, right? As one approaches retirement, in this case 65, you see that blue dropping and the orange picking up, or that yellow picking up. And the distribution of stock to bond is changing. Now, this is something that people can do in their retirement accounts on their own, right? The target date just does it for you, right? You don't have to worry about it then. But there's problems with this, and we're going to get into it. I mean, there are problems with it, but it's not a bad thing, right? This is not a rag on target date funds, right? If someone's a DIYer out there and they just kind of want a solid option to go into, right? It's not like this orange line is doing bad, right? It's not as good, but it's not bad. The point that we want to make is that there's almost always a better way relative to cookie cutter. And if you kind of consider target date cookie cutter investment approach, that's fine. You're going to get a decent cookie. But you can bake a better cookie if being a bit more thoughtful and targeted with your investment approach. Okay, so again, blue line is the approach that we utilize here, and we would refer that as more of an evidence-based investment approach. And let me get into the difference driving these two things. Okay, keep in mind with a 403b and 401k, you are limited to the investment options within that plan, right? You cannot use whatever you want. You have to use the investment options within that plan. So we're inherently limited. What we are doing here is really quite simple from a conceptual side and just a grind from a data side. Take a look at this blue column here. This is a target allocation, right? And in a perfect world, if you will, someone's 403b or 401k would be approaching these targets or hitting these targets as closely as possible. And we'll get into why this target allocation is important in a moment, but just bear with me and take that as a fact for a moment. And then over here in the green columns, we have the evidence-based approach that I just mentioned. And then this orange column is the target date equivalent of this green approach, right? And we're just going to compare the two approaches here from an asset allocation standpoint. To our left here, right, we have stocks, everything on the top side here, bonds, everything on the bottom side here, and then we just have that broken down further. United States versus international stock, bonds, United States versus international, and then subdivided further within the United States side, the US side, large, medium, small companies, and then kind of a miscellaneous category here, other. And then even further for large, we have value, blend, and growth. Okay. Down here on the bond side, we have corporate bonds, right? This is like companies. So this is like Apple or Chipotle issuing a bond. Then we have government bonds, right? This is going to be municipalities, like state bonds or the federal government. So think treasuries. And then again, international, just a broad category, but this is just non-US bonds. And that can be both corporate and government bonds issued abroad. Okay. Again, the target allocation, we're just trying to say, hey, within US large company value, we want to try to hit about 8.8% of the portfolio to fall into that category. Okay. And then you just can go down the list here. All right, so let's look at our investment option in the 401k. Again, most people come to us with the target date fund, the orange. And you'll notice here, you know what, I'm going to start with the punchline at the very bottom. This 33.8%, what this is telling us is that if you look at the actual allocation for this target date fund in these various categories, and you sum up the difference of what it is versus what it should be, we see down here that there's almost a 34% deviation from kind of what an optimal target would be. Okay. Again, this is going to be important in a moment when we talk about the philosophy. If we look at how the recommendations we're making here pan out relative to the target, you'll notice the difference is much lower, about 3%. Right. And all that means is, right, the percentages here, 8.8 versus 8.7, obviously quite small, 13.4 versus 13.5, et cetera, are just much smaller on the whole relative to this target date fund. Okay. Now, before we show you the why behind all this, you come back over here and you can see that that small difference here, right? Just how you're allocating in your 403b or 401k has a meaningful performance difference over time. Now, down here, right, we're looking at 10% versus 9.6. That feels small, right? We're talking 0.4%. If we were to illustrate the difference of 0.4% in your portfolio over a 35-year investment career, we're talking hundreds and hundreds, if not millions of dollars in difference for most physicians, just by that almost 0.5% performance differential. Right here, we're just looking from 2017 to June of 2024. Okay, so hopefully this makes sense. And if you want to stop here and just say, hey, I get it, you can move on. If you want to know more of the why, right? Why do we have this target allocation the way it is? Because this is really the driver here, right? This is what we're trying to hit. And the question really in anyone's mind should be, well, my gosh, okay, clearly if we get closer to this target, this optimized portfolio does better than a target date fund. But why do we have this? Why are these our targets? It's very deep. I mean, that question goes very deep. But let me just come over here next, and I'll show you here. In a very general sense, on the equity side, and I'm speaking in generalities here, but the philosophy supporting this is whether you are looking at U.S. or international on the stock side, smaller companies and more value-oriented companies and more higher profitability companies tend to outperform larger companies and more growth-oriented companies or lower profitability companies over time. So the more you can tilt the portfolio, and there are limits to this, but the more you tilt towards these limits of small value profitability, historically speaking, there's a much higher likelihood that that portfolio performs better over time relative to this target date, which is more of a market cap approach. And market cap just means you're not really tilting to any of these value, small, or profitability. You're just trying to capture rough market returns for these various categories. Okay? Now, internally, we break medium and small down further into value blend growth. We're just showing large here, broken down value blend growth for illustration purposes. And then even on the international side, we break that down between emerging markets and international developed, and then even subdivide it in there within small, medium, large, and value growth blend within the international emerging side as well. But again, it's just a lot to kind of shove into one graph here. So we're really hitting kind of the high level here with US. There are also premium differentials on the bond side. Generally, that relates to term and credit quality. Pardon me. And that's also kind of baked into this. We're not exactly seeing it in this snapshot, but moving the portfolio towards lower term and generally knowing quality is maybe the best way to put this. Also produces higher expected returns over time. Okay, so that all being said, we're going to come out of 403B and 401k land. Remember, we're limited to the investment options there. We have to use what we got there, and all we can do is do our best to optimize to that target. Quick example, sorry. This is a physician we work with, and these are all the investment options that they have within their 403B. What we are doing for every physician we work with that has us helping on their 403B or 401k is we are taking each investment option that they have, okay? We are doing an x-ray or looking into each of these funds. We're looking at all the thousands of underlying holdings that each of these funds hold, and we are recategorizing those underlying holdings using a more objective criteria over here to the left, and then looking at the percentages that each fund holds within these criteria, okay? And then again, we have a process internally then that says, okay, hey, here are all the options that this physician has. Here's the underlying breakdown for each fund. What percentage of each fund would we need to hold in order to optimize against this target allocation? Right, that's how we can get this down to so low, this 3% here. Deviation is we're just asking what percentage of each of these funds need to be held in order to optimize against this target allocation we're going for. Okay, that's the underlying process, right? Again, now zooming out of 401ks and 403b world and looking at investments in general, right, where we are not restricted. We can invest in anything we want. I just want to hit home here the notion of why this is so important to do over time. 2 lines again. Blue line, green line. Green line represents kind of that target date or market-based approach. Nothing wrong with it, okay? It's honestly the philosophy that we are built on, and then we just take it a step further with this evidence-based approach. Just to show that there's more you can do, right? So the green line over time does fine, and you can see how highly correlated these lines are, right? When one is going up, the other one's going up. When one's going down, the other one's generally going down. But again, the blue line represents this evidence-based approach, or an approach in which we're leaning into smaller companies, we're leaning into more value-oriented companies, we're leaning into higher profitability companies. And you can just see the difference in the two approaches, right? As time goes on, this goes all the way back to 1994. Again, using an index or a market-based approach yields the green line, and using this more factor-tilted approach gives you the blue line. Now, what you don't see here actually is risk, right? We're just looking at how the performance of a dollar did over this time. Obviously, the blue line outperforms the green line. Now, the green line doesn't. Sorry, in any given year, the blue or green line might be doing better or worse than each other, right? We don't see that here, but any given year, green can outperform blue sometimes. But over time is what we're really going for, right? Over multiple years, which does better. Finally, risk, standard deviation, not shown here, but a huge part of investing. And people tend to focus on return, and that's why we kind of put it in these terms here, because we know that resonates. But risk matters. All right, what we're not seeing here is you actually look at the standard deviation of each of these lines over time, right? Standard deviation is a measure of up and down movement in the portfolio, or risk, right? Generally, the more up and down movement that a line has, the more someone has to be willing to kind of be able to keep their seat buckled and handle that kind of up and down movement in their portfolio. It's just it feels worse for somebody going through it because there's a lot more up and down. But the point that I'm trying to make, is that the blue line actually has a lower standard deviation than the green line. So not only are you getting better performance, but there's slightly less volatility, there's slightly less risk in that blue line. And that's the whole point here, right? Whenever anyone is investing, the notion here is you want to really optimize the portfolio's return at any given level of risk that a client is willing to accept. We're just taking these principles that you see here on the screen that we have in our portfolios, and then we are overlaying that into the 403b and 401k, in which we're limited on the investment options. We can only use the investment options within those accounts, and so it's just taking the principles here though and bringing it into the 403b 401k world. So hopefully that is helpful and kind of shows why getting this right matters so much. And it's not to say anything is really good or bad, right? It's kind of any investor's preference. Anyway, I'll just stop there. Anyway, I hope you found this of value. And of course, till next time, hope you're well.